Hello listeners and welcome to the Montel Weekly Podcast, bringing you the most topical energy matters in an informal setting. I think it would be fair to say that we're in the middle of an unprecedented period of global gas oversupply at the moment. So, listeners, if you have wondered how long the glut can last, or what the strategies of gas producers and shippers may be, or if there are any bullish factors out there, or even how low wholesale prices can go in Europe, then you're in the right place. My name is Richard Sverrisson, and I'm joined today by Kjell Eikland, Managing Director of Eikland Energy. Welcome to you, Kjell.
Thank you very much, Richard.
I think I'd like to start by talking a little bit about what we've seen so far this year. This is after the Ukraine-Russian gas deal has been signed, which was kind of maybe supporting some prices. But now we're seeing TTF spot prices under 10 euros, Henry Hub under $3, and Asian prices under $4. What's going on, Kjell?
Well, for the first time, it really started last January, but for the first time in history, we're seeing a global supply glut and a globally interconnected gas market. So there's no place for oversupply to hide anymore.
Okay, so what are the next moves here? I mean, what can we expect from February? If the mild weather continues, can we expect prices to continue down, supply to continue flooding into Europe? What's your view here?
My view is in many ways similar to other observers or the message that has come across by analysts the past couple of years that there would be an expectation of a global surplus of LNG at least until 2021, 2022.
Okay.
And last summer we did some work that suggested that the glut could even continue till 24, 25. Mm-hmm. But one of the things that the analysts typically have not looked at was the short-term market implications. There was a general observation that the surplus could be managed.
Okay, so talk us through that. What are the short-term implications of managing this glut?
In a typical liberated or liberalized market, you get an adjustment of supply and demand driven by prices. And what we're seeing now is that LNG is a very rigid supply source. In a sense, it's almost like a must-flow source of energy. Mm-hmm. So it doesn't, in the short term at least, it does not seem to react to low prices at all. Mm-hmm. And that, of course, does not bode well for those who expect higher prices in the next 2 months.
I should also mention, Kjell, that you're the managing director, if not the owner of Aegis LNG, which is a ship tracking and an information service for the global LNG market. But what are you seeing here in terms of the short-term drivers or the short-term factors driving this market?
Well, it's interesting. Last year, we saw a few weeks ahead of the initial price drop in January that there was a fairly significant volume surge, and the market was taken by surprise. And another blip came in March that led to a further drop. The system that we use, Aegis LNG, is basically supply forecasting 3 to 4 weeks ahead. It's just not ship tracking, it's supply forecasting based on fundamentals. And what we're seeing now is that starting in November, there was an unprecedented buildup of supply, quite a bit earlier than what we've seen in the past few years. And yet, winter temperatures did not seem to materialize. And there's certain doubt about the Chinese economic growth and demand. There was a startup of a pipeline from Russia into China. So it's weakening the potential demand for LNG there. But what we saw is that the delivery profile in December continued well into January and has not really abated until the past 2 or 3 weeks. So way too much demand, or supply rather, for the market to handle.
And this is Asia and Europe, or global, trying desperately to find a home, this LNG, if you like?
That's right. I mean, most of the demand obviously is in Asia. But you saw a really global supply surplus, and the way markets work right now, the ships can change direction at any moment based on the arbitrage opportunities. So one day the ship can aim for Asia, the next day for Europe.
Really, it's a matter of hours. They're just looking where they can get the higher prices, I suppose. So they make a decision, just a snap decision, as if they're mid-Atlantic or.
Well, I wouldn't call it snap decision, but it's certainly something that's an ongoing exercise for at least a third of the cargoes, where to sell the cargo with the best, or not necessarily best profit, but least amount of loss in the current situation.
Absolutely. So a third of global cargoes, how many ships would that be?
Well, in terms of the fleet, we're tracking about 560, 70 vessels at this point. So we're talking about close to 200 vessels that could change direction at short notice.
That's substantial. You said the wave of supply carried on from January, or from the turn of the year and into January, slowing down a little bit over the last 2 weeks. What's your prediction for the coming sort of 3 to 4 weeks to the end of February?
What we're seeing is build-up of storage, both floating storage or implicit floating storage and actual in-tank storage.
When implicit storage, what do you mean?
By implicit, I mean it could be ships not sailing as fast as they should. They're taking a good time to get to market. So that's a way to store LNG as well.
Absolutely, yeah. So you were saying you're seeing a lot of this in storage over the coming 4 weeks?
Well, the operators, importers, buyers of LNG now has a challenge when they see that the winter is coming to an end. What do we do with the incoming cargoes? At the moment that operators decide this is it for this year, there will be a significant turndown of delivery frequency into the markets. So what will happen with those cargoes that can be potentially delivered to any other market? The capacity to produce LNG does not disappear. So the potential to deliver LNG is there. And paradoxically, with current low prices, producers would like to on-sell as much as possible to cover or to recover as much of their costs as possible.
Yeah, we'll come back to those producers because they're in quite a tricky situation if one looks at the market, the current market situation, and which leads me on to my next question is, do you see these low prices to continue? Is it a short-term blip or is it a longer-term trend that we could see lasting, as you mentioned, into maybe 2024, 25?
If I were to put my money anywhere, then it would be for this to be a long-term phenomenon. That we could end up with typical seasonal markets where you could have a fairly good strengthening in the top winter months. But basically for the off-winter months, and certainly summer months, fairly low prices and really marginal prices.
And presumably very high storage as well.
Well, so storage, not necessarily so, because if the market all of a sudden relaxes and say we can always get hold of the gas, whether it's in pipeline form or it's in LNG form, they can end up turning down on their storage levels.
Okay,
simply to minimize working capital.
Right, so storage doesn't become that important then because of the availability of aid-by cargoes or pipelines is what you're saying. So.
Yes, interestingly, 2 years ago, when there was a North Korean conflict or the threat of war, all of a sudden both Japan and South Korea got nervous. So they after having depleted their LNG stock, their strategic storage, all of a sudden they had to rebuild that and drove up prices quite significantly as part of their stock replenishment. Commercial and strategic decisions like this really can affect the market quite strongly.
But returning to the producers, I mean, there's been a lot of focus on the US here. And how do the US producers and exporters react to this period of very low prices?
The lowest cost US gas sources is 50 cents or less. So there will always be a base that makes money almost regardless. On top of this, there is associated gas, particularly from the Permian now.
In the Permian basins in the
That's
US.
Right. That's right. That has negative costs implicitly. As long as oil prices are reasonably strong, even at $55, $60 as we see currently, there can be a negative price of natural gas sales, and they will still continue drilling and producing. So the U.S. as a marginal source of natural gas does not really help in terms of turn-down capacity. They will not turn down as it is right now.
So they'll keep pumping and shipping.
That's right. And on top of this, for the foreseeable future, you mentioned that Henry Hub prices were around 3. In fact, they're at now about 190.
Okay, so they're under 2.
That's right.
I'm already out of date, Kjell. Thanks, yeah. So they're under 2.
That's right.
How about producers elsewhere? So Qataris or the Australians or to other producers?
Well, Qatar has, by many estimates, including our own, a cost of about 50 cents as well. Once wells are drilled, whether you have shale gas in the US or the large fields elsewhere in the world, once you have them up and running, the marginal costs are negligible. So that does not stop natural gas from flowing.
Exactly, but it has to have a home, though. It has to go somewhere. And if storage are full, the market's oversupplied, then you're just basically driving prices down.
That's right. But on top of this, you have the complication of what's called lifting rules in fields. You have contracts that are signed that have take-or-pay obligations in them that make it required for producers and sellers, or buyers rather, to actually receive this LNG. So the question is, who has the burden? Who will adjust? It's not the producer necessarily. It could be the buyer who has committed to buying LNG or natural gas, as the case may be, on a medium or long-term basis. So they are paying fixed charges at a substantial level. And we're talking here about anywhere from $2.25 to $3 per million BTU for US LNG.
And these are contracts that obviously were signed quite some time ago.
Yes, inflation adjusted.
But what does this do to the companies that are piping the gas? We seem that Gazprom, for example, in January sold close to 4 BCM via its electronic sales platform. How do you see them reacting?
I think all producers, if you're talking about European export or producers right now, they are challenged by the current situation. There's undoubtedly the threat of the US LNG in particular coming in. But in broad perspective, Australian LNG is just as significant. And how do you react to this really surge of energy hitting liberalized markets and with the price impact that is pretty much immediate? It is unprecedented at the scale that we're currently seeing it. So what we heard just a short while ago that Equinor had held back natural gas sales because of LNG. What we're seeing, though, is that overall exports from Norway in 2019 hardly budged from 2018. So it's a minimal effect. We see, however, that players may be shifting export from UK one day to Germany or France the other day. So they try to optimize the markets. So really into the portfolio and trading strategy play here. But in the big scheme, the volume effects for the time being have been minimal.
Okay, so they're still pumping it through the pipelines as they have done previous years, which have been record high, actually, levels, haven't they, from both Norway and Russia? That's
right. And Norway now is pretty much at the plateau level, at the top level that we can actually handle. We may be able to do 4 or 5% more, but the fields cannot handle much more than what we're doing anyway. So for this to have any material effect on pricing in Europe, compared to the inflow of LNG that's actually taking place, we're talking about much more significant adjustments that are required by some player, some supplier in the market.
If I understood you correctly, Kjell, what you're saying is that the way they're reacting to this unique situation that hasn't been here before is optimizing their trading, optimizing the way that they ship these volumes, either to the markets or in what kind of capacity, whether it's day ahead or intraday or whatever. Would that be a fair assumption?
It is. We have a complication with regard to LNG, though, compared to both electricity and natural gas, certainly in Europe and the US, and that is that the markets are extremely organized. You, through the remit system in Europe, you know exactly where outages take place, how long they will last. You go through the nomination process through exchanges, and you can see how the forward curve looks like. With LNG, people don't really know how much is coming into the market on any day. All of a sudden, several ships may target Japan or target Europe or not target Europe. That is not scheduled into the systems. So you add uncertainty here that nobody really knows how to handle yet.
Handle that supply from the LNG.
Or the uncertainty of what will decide prices. And that brings in a risk element in the pricing scheme that we've gotten used to in the past decade or so, that things are essentially forecastable, to use that term. LNG adds an element of uncertainty that producers and buyers alike have trouble finding out of.
And if they have trouble finding out, then the market more generally will certainly find it difficult to analyze or forecast both supply and potential prices.
Yes, and sometimes you have a risk premium when you fear that supply can be short. But currently, we may actually see the opposite, lower than rational price, simply because the market believes that there will be a flood of LNG coming in that may in part not materialize. But such is the uncertainty right now.
I'm just wondering as well, we've talked about supply, Kjell, but the demand side, where is the demand for this wave of LNG, this gas globally? Where is it coming from? I mean, is it from the power generation sector in Europe? Is it from, we've seen it, certainly Asian gas demand has driven up prices in the past, especially in harsh winters. But where's it going to come from? Especially in light of, the move to decarbonize and move away from fossil fuels.
In Europe, we do have a certain challenge because already the flexible power market is pretty much saturated with natural gas. There may be a cargo or two extra that can be brought into the market, but minimal in the big scheme. What we've seen, though, in the past 2 to 3 months is that gradually the low prices have really challenged coal plants in Asia.
In Asia? Okay.
In Asia. We expected to see India as a big potential marginal importer, but that has not happened. Instead, there has been a surprising strength in Japan, Korea, that has helped absorb some of the surplus to the level that we don't think that this necessarily has reflected the actual price level in the market, but it has been unsold. Literally to minimize losses and to satisfy the take-or-pay requirements.
Okay, so how about Europe?
Very little. I mean, obviously we see a very strong demand for natural gas in Britain, and oil certainly is out a long time ago. But we have a situation now where renewables have helped LNG somewhat the past couple of months, simply lack of renewables production. As solar comes in the next few months, and also with traditional wind in spring, we may actually see some loss of market here as well.
Also market share?
Market share, yes. Yeah.
So would you say LNG and renewables are a good partnership?
The LNG companies, gas companies, like to see those sources as good partners. But as it is right now, they actually compete for the marginal supply. So in the big scheme of things, renewables will outcompete LNG simply because it's delivered on an instant basis and LNG is not.
And it's it's extremely low cost as well.
That's right.
Kjell, thank you very much for a fascinating discussion. I think it would be very interesting to look at the supply dynamics going forward, and I'm sure we'll welcome you back on the pod at some point later in the year to see how the things have developed, if they're according to your forecast. So thank you for joining the Montel pod today.
Glad to be here, thanks.
Please, listeners, remember to keep up to date with all our stories on Montel News and follow us on Twitter, LinkedIn, and subscribe on Apple Podcasts and Spotify. Goodbye.